Hey, it's Cody A here. Today's video is going to be a bit different. Today I want to show you my special one-on-one interview with TD Bank to talk about stock option investing. I pulled the top question that asked by you guys and I answer it live. We talk about if the only time you should sell the put option is after a stock has dropped 10%, and what do we do if our position are being challenged, and a lot more. So you want to stay until the end because the last 5 minutes of this Q&A will help you avoid losing a lot of money and it'll help you increase your return.
All right, and then so we have a question from Asaro saying, how do you set your exit points?
How do we set our exit points? So based on our set and done strategy, we exit around 50% of the premium we can get, but it might be different for you. And sometimes I could close sooner, sometimes I can close even with more premium, but usually that's 50%, is because, like I said, I don't need to grab the whole pie. I'm looking for a really risk-averse way of getting half the pie. I'm really happy for it, and I close up and then decide whether I want to put on another tray. And every time I put on a tray, I already have a bracket order of when to take profit and when do I take losses. I always have that in mind. So even if I don't have internet on my phone, I can still play the strategy really well, and I know my probability and proven over the years.
So we have a question, very specific one from Syed, asking, and I don't know, maybe he's seen some of your videos, because I know I've watched some of your videos, and you sometimes have a certain goal as an income for the day. That may have graduated to higher amounts. That you have your team and so on. But Syed is asking, if your target profit is $100 per day, for example, and the credit spread you are selling is making $20 per contract, would you go to higher deltas or increase the contract per trade to get you to the target profit? So I think looking at selling more contracts is what he's saying.
What I'm understanding here is Isaiah is asking, and my goal is making $100 per trade or $100 per day, whatever that is. Can I increase my delta to increase my overall rewards per trade? That's how I understand it. If coming from that standpoint, again, we don't really focus on the return. I never set goals on how much I need to make per month. It just kind of rolls into it. And because we've done enough, we have done back testing, so we know our percentage is double digit per year. So we don't really focus on, there are months I make 1.5, there's months I make 5, 6, and there's months I can make more because of higher VIX, but I don't force it. I let the market decide and always play my probability game. Because in the long term, if the market doesn't allow me to make money, I don't force trade. I don't say I need to make this amount per month, because that's really when the market is very volatile. The market doesn't really know what you're doing. But when you really try to set a goal like that, right, I don't think it's the right goal to set, in my opinion, because that's just not the right way of doing things. And I think that's just a rule of life as well. You can have a minimum that you kind of know, but when you try to chase the return, you can get into a lot of trouble. And when you increase delta, a lot of times you have to make sure you understand what is the risk of that. When you increase the delta, that means there's a higher chance of getting in the money. Are you ready for that? Are you ready to maybe roll the position? Do you know how to roll? Do you know when to roll? Right? Do you know when to take loss? Right? And that's where a lot of things that people don't talk about, that we talk about in our system, just we give you the worst case scenario. If you're okay with that, you know how to deal with it. The rest is return.
We do have another winning poll question, or we'll take the top two again. The first one that did get the most votes was, can you please set out a recent typical option ETF trade that demonstrates a good strike, good spread, and good risk?
Our set and done strategy is not done on ETF. It's actually done on future options. But I just say I'm rolling with it. I'm going for the SPX. Okay, everyone knows that. I'm going for SPX. You kind of, you open it, you look at the support resistance from the chart, and you look at the VIX, right? See whether it is above the historical average, because VIX averaged between 16 to 20 for the last 30 years. Is there an anomaly? Yes, there's an anomaly, but generally if it's higher than 20, you get paid more. Your risk is a lot lower because it's already very volatile. People are kind of greedy. You can high even further out from the delta, right? But if we open an SPX, you can look at what's the risk and reward you want to make. For me, is for our strategy, we never go delta higher than 10, but But again, that's up to you, right? That's just based on our testing. Our win rate is around 95 to 98%, right? So that's just for us, and we don't go higher than that. And you know, the strike price could change based on the VIX, based on the individual, you know, IV of whatever vehicle you're using. But you know, we're aiming for 1.5 to 4.5% per month. That's our target. We've been hitting it, but I don't know what's your target, and that's the target we're very comfortable with. I've been hitting it right in the middle, right, over the last 7 months as well, since my public account shows. But again, it's up to you.
One other question that we have, so this is the runner-up, it looks like, in the poll, is how important is technical analysis or a technical analysis background to selling credit spreads? Do you have to have that really major technical analysis background?
Here's a funny thing. A lot of big funds, they say they don't look at technical analysis, but that's not true. A lot of people look at it, even AI looks at it. But here's the flip side of things. If all that matters is technical analysis, the AI will be billionaires already, right? But there's none AI billionaire, and all the funds still have to look at fundamental, because technical analysis do show you the price action, but there's a reason there's a lot more algos in the market, so it pushes the price up. Whenever it goes up a lot. Whenever it goes down, exaggerate as well. So price action is important, but I would say stick to the basic, looking at support, resistance, and then just know your probability and know what's environment, and just be greedy when others are fearful, be fearful when others are greedy. I think as long as you stick to those, technical analysis is just one-off variable. And a lot of time, the chart might show you one thing, but you know, it might be opposite. But technical analysis is part of the tools we use to increase our win rate, but not the absolute win rate, if that makes sense.
No, that sounds great. So I've got another question I really wanted to get to coming up here from, it looks like it's from Greg. So let me see. We should be able to possibly throw that up on the screen. There we go. So it looks like it is up there. So how many trades do you make in a typical month? I know we're getting personal here, but let's see if you're all right with answering that.
How many trades do I make? So how about I put it this way? Because I don't know your account. You don't know my account. My account's 7-figure. Okay, so I just say each trade I allocate $20,000. Not that I use it, but I know the maximum margin requirement. That says 10,000. Right? I allocate 20,000. Why? Because I want to be safe. I want to be the last one standing. If COVID hit, VIX goes to 90, I'm still okay. Right? That's the way I come up from. So if you come from the standpoint, $20,000, I make one trade. $20,000. Each $20,000 I make, 1 to 2 trades per month. You can calculate it. But a lot of time when we have a bigger account, our strategy don't change. I just increase the quantity. So do I count as how many trades, or do I count as one trade with so many quantity, right? And once you get over 50, then you might get into a different pool, and you might get into the commercial level, and it will give you more assets, better spreads and all that. But generally, I would say it's the same trade, just with more quantity, and 1 to 2, maybe 1 to 5 per month. That's it, right? Just overall same trade, more quantity.
We do have a question from Troy saying, can you elaborate on the desired gamma for a trade? And maybe if you can too, Cody, can you also just remind us what gamma is on that one?
Troy is really advanced level, because you're looking at gamma as well. Gamma is kind of like the risk when you get closer to expiration day. For more geekier people, gamma is the acceleration of delta, right? So I come from an engineering background, so there's speed, there is acceleration, right? So imagine there's different derivatives, but just think about gamma as in like the slope, a slope of a curve, right? So the steeper the curve, the steeper the slope, and the faster it moves. So if there's a higher gamma, that means when it's usually closer to expiration date. That means if there's a small change in stop price with underlying price or index price, whatever that is, you have a bigger effect on your premium, right? So if the stop price goes in your favor, your P&L will go in your favor a lot, right? If it's a high gamma. If it's a low gamma, then it will go less, right? So usually the further out the expiration day, the lower the gamma, right? I think that was the question. We can repeat the question. Sorry, I go around and try to explain, but I forgot what's the question.
Oh, that's okay. He was looking at what was a desired gamma. Like, is there anything, do you ever have a rule of thumb, or is that something you even really look at
No,
that closely?
I look at more of expiration date. I just try to avoid high gamma. High gamma is exciting. I know it's getting a lot of people's blood pumping, but again, ours is said and done, right? We stay away. We try to avoid anything within 14 days because the gamma is really high. You can make quick money and all that, but we don't like it. We just want the slow ones, even if it move against us, it's a really slow game as well. And we just let the time decay take care of our profits, right? Just like the insurance company.
So it looks like we have a question from Zena, and it is saying, can you share a time when a credit spread you wrote against an index went very poorly and what you learned from that experience? So tell us, what did you learn from a bad experience?
When we're doing back testing before a said and done strategy going live, we tried on different index, right? For example, I'm not going to name names, but this one's fine. For example, QQQ, right? Mostly top 100 tech stock. There's even smaller index that tracks even more volatile stocks, right? So if you're using a strategy on those, just knowing that the chance of you getting in the money, getting challenges a lot higher. Yes, your return is a lot higher on a monthly basis, but you will more likely to get challenged. And I would say, our win rate is 95 to 98%. You're like, okay, well, so what's the 2 to 5%? Those are the time we could get challenged, right? So when we get challenged, there's a few options, right? First of all, it's really a little bit more complicated than you thought, but we just look at the P&L, right? If the VIX shot up and is not in your favor, everything is going against you, then we could take losses. So far, we haven't, but there's times where we have to roll it out just to buy ourselves more time because the market might just be the quants pushing it, and we just want to buy ourselves a little bit more time. It worked out pretty well. But if events like COVID happened and 2008 happened, VIX shot up and all that, either we take losses right at our stop loss point, we take all the profits we had over the months, over the years, we take a 3 to 6% loss. That's okay because we collect so much. We're not back holding anything. But if we really want to ride it out, then we can roll some, take loss on some. There's many scenarios, but you have to know when to roll, and are you ready to get into that rolling game? Because rolling game, you have to track it carefully, right? What price you get in, what price you get out. And it could be kind of Excel spreadsheet activity going on, right? Otherwise, you don't even know you're making money or losing money, right? So I'll say make sure that you look at those, right? That's what our team are working on a weekly basis. That's why we have hours of calls or back testing and say, if COVID happened, if VIX goes to 40, if this happened, if our underlying shot up so fast and we have a bigger call spread, what will happen, right? So we know when that happens, we know what to do, and we're not panicking, especially when there's a lot of masterminds that are, looking at us. So we're prepping them, right? We always tell them the worst case scenario, so prepping their muscle and mental health if we're going to go through that, right?
Mateo has a question saying that when you do an option, do you wait until the market drops more than 10%? So I don't know if you can answer that one specifically.
I'll probably ask the question back. How often does your underlying drop 10%? And what duration is that? Does that mean 10% in the month, 10% in the day? I don't know how to answer that, but I'm guessing where you're coming from is if you're selling a put or a bull put spread, should we wait until the market kind of pull back, right? And here's the thing. If it pull back, you might be thinking in your head, it might pull back more. But generally, when the market pull back and you try to put on a neutral to bullish position, you will get paid more on premium. And that doesn't mean the risk is lower or higher, but that's just based on your analysis, right? But I don't know what 10% means, right? Because I need to know the duration and all that. But if that's your criteria, that's your criteria. But if it's 10% in a day, you might be waiting until COVID, the next COVID, right? But if it's 10% in a month, maybe more likely, 10% in a year, then, what are you going to do between waiting for the 10%? How are you going to generate cash flow, right? So that's my question. I kind of throw it back.
Yeah. All right. So we do have the poll questions up, and the winner looks like pretty big vote on this one for sure too, which is great. is what level on the VIX do you generally find to be the sweet spot of potential risk and return when writing index options?
Very good question. I think that's probably the magic bullet question, right? It's like the blue pill or the red pill, kind of in the Matrix game, right? Before I answer, let's go back into history, right? Because we do a lot of those research, right? In the past 5 years, the lowest VIX is around 11.5. That happened between 2018 to 2020. The next lowest point in the past 5 years of VIX is at 16, between April 2021 and November 2021. In the past few weeks, our VIX is approaching 16. Right now it's about 18, right? And like I said early on, if you guys pay attention, the average VIX ranged between 16 to 20 over the last 30 years. Now, if we look at the anomaly of all-time high of VIX, right, it's 82.69 in March 16, 2020, and the previous highest one is actually 89.53 in 2008, October. So if we look at that, there's a huge range, right? Range between 12 to like almost 90, but usually average between 16 to 20. And right now it's at 18. So we're right in the middle of the middle. So do I like to sell options when the VIX is higher? For sure, because I can pay more, I can hire further out. To me, my risk is lower. But do I not do anything when the VIX is lower than 16? No, I still do something, but I generally be more conservative, right? Like I said, I don't push for certain returns. I let the market tell me what to do. So usually the VIX, when it's higher than 20 and higher, and has been, kind of on the up, usually that goes 3 days up and then kind of 3 days down thing, then we'll make the decision accordingly. And we, of course, when we're selling option, we want to sell when the VIX is high. And on that last note, I will say, be greedy when others are fearful, but, and, be fearful when others are greedy, but you got to make sure when others are greedy, you don't get too greedy. Otherwise, when it becomes too fearful, you have no dry powder to do anything, and you're just looking at your screen and can't capitalize on it, right? So sometimes it's more of a discipline and having the right people around, and you can't really control VIX, but you only can control yourself, right? And you know your criteria, and that's my criteria. That's how I teach, all my students.
So the other bigger voted question was, so the runner-up was, let's say a credit spread is moving against you on the short leg. Do you roll or close out the short leg only, or the entire spread, and why?
So it really depends on your intention. So let's put it this way. If your intention of selling that credit spread is never to own any underlying, that means you probably don't have enough cash to buy 100 shares of anything, or maybe the ticker just doesn't allow you to buy it, right? Just cash settle and all that. Then you're playing a probability game, right? Then you got to decide, okay, if it goes against you, are you making money on the long leg, right? Depending on how far away are you selling at expiration day. Sometimes it might come too late, right? Sometimes the theta might eat away all the long leg, right? That really depends on your experience. But if you can take profit, sure, take profit on the long leg and decide what you're going to do with your short leg, right? And usually the smaller the spread, the easier for you to roll, right? Where you can take losses and all that. Now, that's first scenario. Second scenario is, you know what, Cody, I'm doing this on individual stocks. Let's say whatever ticker, Apple. Okay, Apple is Warren Buffett's favorite, so don't blame me for it. So let's say on Apple, you sell bull put spread on it, but your intention is to enter the trade, make some premium, and have a defined risk. But if you have enough money to own 100 shares of Apple when you're selling a credit spread, a bull put spread, and all that, you have the option to, if Apple drop, what you could do is you can actually, take profit on your long leg and get a sign on your short leg, knowing that eventually it will come back up. So it's actually, we kind of spread out the bull put spread and take profit on what's been take profit, and then just get assigned the stocks, and you like the stocks, you want to hold it for the long term, you think it will come back, then just don't take the loss, right? And that will give you a lot more options. So really two options I look at, and hope that helps.
So just in the essence of time, I want to get to a couple more questions, and I've got one here from Oliver. saying, how do we know if no early assignment exists for an option? So I think Oliver's thinking if you're thinking of stock options instead of the index.
Option world is, a lot of things you can Google. A lot of things takes time to understand. A lot of things takes tears and sweat and blood to understand. I hope you guys don't have to go through that. So do the maximum research and understand underlying stocks or tickers you're doing options on, and I'll say go from there, right? And just Google research the hell out of it, and knowing that if there's early assignment, there's none, what can happen, right? And just try to dig into it. A lot of time it's not an easy thing to do, but if you want to be good at what you do, you got to do it, or you just follow someone that's already done it, done all the hard work, and pay for it.
Absolutely. So I got one more I want to get to from James, just saying for the low probability credit spread trades with low premium, would you rather let the trade expire worthless to get lower commission costs, given the strike is, say, 15% out of the money?
Like, James, what your concern is, let's say you've already paid $10 for the commission, and you only get paid $30, or even worse, $20. So you open a trade, you pay $10. Now you want to close the trade, you pay another $10. So why are you doing this, right? So that's another reason why we go further out the expiration day. We make less trade, right? And depending on which broker you use, of course, TD is a good platform, right? They're continuing to improve their platform. I think with Swim, right, they continue to improve the robustness and giving you guys more ability for back testing and all that, right? So definitely check out TD. But there's other brokers if you guys are interested, right? Depending on what strategy you guys are using. But just keep that in mind that, if your strategy doesn't collect enough for you to overcome your commission, it's probably time to make sure you get paid more so that you have the choice or the option to close early, right? Because if you start waiting everything until expiration day, there's a saying, right? It's kind of like you're kind of picking up nickels in front of steamrollers, right? So got to be very careful of that as well.
In the meantime, I do have a question from Jonathan that's saying, how do we learn more about the set and done strategy?
So again, shameless plug here. Just go on YouTube, type in Cody Ye, first name, last name, and you'll find my YouTube channel. We also have a Facebook group, more than 4,000 people. But on the YouTube channel, I've run, a 10-minute video, and we have a 1-hour webinar like that. And really, if you're really good to go, you're like serious about it, then just get in touch with our team, fill the application. But, get to know more of it, and, whether you want to do on your own, whether you want to do it for our team, doesn't really matter, as long as you don't stuck where you are and trying to go in that spiral of trying to go from strategy to strategy to strategy. Because so many people who approach me told me that for years they go on strategy, this one works, and then stop working, jump on another one, and then overall they either break even or even loss, right? So that's all opportunity cost, in my opinion.
Hey, thanks for staying until the end of this video. Clearly, you found a lot of value. So if you want to learn more about how you can reach your own financial freedom through our own said and done strategy, making 18 to 54% per year, feel free to use the link in the description to book a call with me or my team to talk about how to advance your financial journey.